Hello, and thank you for joining us for the next episode of the Data Monetization Webinar Series. This episode will examine data monetization in financial services. This is the sixth episode in a six-part series. A recording of the webinar and the slides will be made available to all registrants. Feel free to enter any questions using the Q&A feature in the Zoom menu. We invite you to follow us on LinkedIn to see news about other upcoming webinars. And with that, I'll turn things over to our moderators.
Hey, thank you, Michelle, and welcome everybody to the last scheduled webinar in our series. And today we're going to explore the world of banking and financial services. And having seen the presentations, I can tell you in advance that like the previous ones that we've had, they're very, very interesting. We've got returning with us again this week, we've got Manjeet Rege, who's an associate professor and director at the Center for Applied Artificial Intelligence at the University of St. Thomas. Manjeet has a PhD in computer science and is a thought leader in the area of big data, machine learning, artificial intelligence. He also has a podcast called All Things Data that you should tune into if you get a chance. So welcome to Manjeet again today. And then also today, returning again is Chris Hohman, who is currently VP of Product Management at the Bank of the West. And Chris has a long career, not in terms of him being old, but he's had a lot of experience in industry. And he's been a product innovation consultant at Wells Fargo. He's also been a product manager at Amazon. He's been a manager at Cisco. And Chris has also got an MBA in marketing and also a BS in mechanical engineering. So he comes well steeped in technology and business. And he's got another really interesting presentation for us today as well. Also joining us again is Suneel Arora, who's one of the senior partners at the firm here at Schwegman. And as most of you have tuned in before know, Suneel specializes in electronics and med technology in particular, but actually could do just about anything other than, I think, hardcore chemistry. He might take a pass on that. But Suneel is basically the brainchild behind this webinar series. And so we welcome Suneel back as one of our co-moderators. And so with that, I'll spin it over to Manjeet and let you take it away.
Thanks, Steve. So with the expansion of big data, social media, and the ability to find or buy nearly anything you need, means that people are accustomed to rapid personalized experiences, and customer expectations are changing, and the financial services industry isn't immune to these new demands. So as a result, there has been a transformation of financial services through digitization. A recent PwC survey revealed that 71% of US banking executives consider non-traditional new market entrants to be a threat, indicating that competition from fintech and companies like Amazon and Apple is putting pressure on legacy financial brands. Evolving consumer expectations for convenience and personalization are creating a need for a more consumer-centric approach within financial services. Financial brands that master the application and analysis of consumer data elevate customer experience and improve marketing ROI as a result of that. Now, in a recent survey, 52% of financial services consumers ranked relevant content as the most important marketing factor that influences their decision to switch to a new provider. So customers know the value of the data and they are willing to trade it for a return. They're willing to exchange personal data for new customized benefits. And financial service providers offering real value for data can earn increased trust and loyalty from them. So the core of all of this is data, right? Consumer data. And there are four types of consumer data. First one is zero party data. So that is data that is shared directly by a consumer with a financial service provider, typically by filling out a survey, basically expressing your preferences. Second is first party data. So this is your customer data, but you are capturing that through maybe some internet cookies. You're monitoring the behavior of your consumer and capturing that. Next is second party data. So now you are partnering with somebody else, and so that second institution's first party data is handed over to you through a partnership agreement. And the last one is third party data. That is, you have these data collectors who are um, uh, getting data from all kinds of resources, from different open sources data, and then collecting that, aggregating that, and companies can use or get that data to get a much more complete picture of your consumer. So I'm going to go through each one of these and talk about them. First one is the zero party data. Zero party data is also known as preference data, and it is generated by consumers directly interacting with surveys, preference centers, polls, and questionnaires. Essentially, any format where they can share preferences and purchase motivations in return for a better personalization or another benefit. A recent Forrester report estimated that by next year, a mere 15% of global brands will be collecting zero party data. In contrast, 92% of marketers said they believed preference data is critical to their growth. So, based on these findings, it's clear that zero party data is an area of missed opportunity for many financial brands as it offers unique benefits. It is highly reliable because it is interest handed over by customers, which has to be reliable. Efficient because zero body data means marketers can simply ask for this data, which is a quicker and a more economical way to generate insights. Low cost because it can be free, or low cost because the consumer is handing it over to you. And then privacy friendly, consumers exercise complete control of their data by sharing their opinions and preferences directly with a brand. So preference centers, um, so so this is an example with TD Bank provides an email preference center to give their customers an easy way to control which types of messages they would like to receive and to gather important insights into which products their subscribers are most interested in. Social media polls can be a unique way to both connect with consumers and gauge sentiment or interest from their audience. So I have an example here from Wells Fargo Asset Management. So they created a Twitter poll to gauge consumer sentiment about the economic climate. When the poll indicated that consumers felt a recession was likely on the horizon, the brand offered consumers financial advice to help them weather volatile markets. Consumer feedback today is amplified by technology advances that make it easier than ever to solicit feedback. So, Bank of America sends 90 million email surveys to its customers per year, and receives more than 12 million responses, providing real-time feedback to their teams through a customer interaction technology called Voices, which automatically sends survey results to a dashboard for easy viewing. In addition to email surveys, Bank of America also collects customer feedback through a digital assistant called Erica, which handles around 50 million interactions in the first year of deployment itself. So the brand's focus on consumer feedback has paid off. In JD Power's 2019 US retail banking advice study, Bank of America took the top spot in satisfaction with financial advice and increased their score by 26 points. Now, what can financial institutions do with zero party data? Finance brands use zero party data to create real business results. For example, um, expanding their knowledge of prospects and customers. Having direct data from consumers about what they want and how they behave can help financial service companies improve customer experience and brand communications. So on the Western and Southern Financial Group site, the brand uses quizzes on a variety of finance related topics to educate consumers and to collect valuable intelligence about customer and prospect behaviors, including how they seek financial help, their investment style, and financial goals. Zero party data could also be used for crafting customized campaigns. Finance brands such as HSBC created an innovative, interactive acquisition campaign for younger consumers in Singapore to drive awareness of four different credit cards. So they had this campaign called Choose What You Love, that encourage users to complete a quiz with lifestyle questions. And then each consumer then received completely personalized song and music video based on their details and quiz answers. Finance brands can use self-reported product interest and preferences to create more effective retargeting and acquisition campaigns. The Bank of Tennessee uses quizzes on their website to give consumers a fun and interactive way to plan their finances. Consumers answer questions about their lifestyle and wants and needs to get an idea of how they can plan to achieve these goals. The data collected with this playful tool provides the bank with crucial details about their customers and prospects. Um, when you gather information directly from customers, you have the power to understand their experiences from their point of view. So brands can use zero party data from surveys to make improvements to customer experience. A payments company wanted to enhance their ability to resolve customer disputes about charges on their accounts. So the company was considering making extensive investments in technology to help the company reduce processing times. However, after soliciting direct customer feedback through surveys and customer interviews, the brand discovered that their customers' major pain point was the lack of status updates during a dispute and not the processing times. So the company was able to, improve their communications during the dispute process and better addressing their customers' problems at a much lower cost than an unnecessary technology overhaul. And finally, improvement in engagement, asking your audience how often they would like to hear from you helps boost engagement, avoids email fatigue, and prevents missed connections. So email preference centers can have the benefit of reducing spam complaints. Consumers are more likely to consistently open messages that they are interested in and expect to have. So that was zero party data. Now, why should financial institutions collect first party data? First party data is beneficial because it is, once again, highly reliable. There are no middlemen between you and your first party data. So you know the information is current and insights gleaned from it are going to be reliable. Um, First party data is also known as CRM data or customer data. So first party data is kind of like your bread and butter, one of your most important strategic assets. So there was a study that showed that 92% of leading marketers said using first party data to get an understanding of their audience is very critical to growth. So first party data is information about your prospects and customers that is collected, owned, and managed by your own company. It is all the information about observed and inferred that you have gathered about your audience, typically collected using tracking pixels or tracking cookies, form submissions, website analytics, app data, social media, marketing campaign activity, and account activities, right? Such as the number of deposits you're doing, the number of withdrawals you're doing, new loans you might have applied for, and things of that nature. Now, what can you do with first party data? Since first party data includes bulk of the information you have collected about your audience, the applications are nearly limitless. The insights you gather from first party data can inform all marketing program components from email, creative, and copy to loyalty program design to crafting in store experiences and merchandise displays. Um, First is cross selling. Um, and analysis of the customer database might help you identify a key audience segment for a product or a service. So ATB Financial developed a campaign to target young consumers, a key segment for the bank's load and go prepaid card. So the campaign targeted 17 to 19-year-old ATB customers who do not currently use prepaid credit card product. So, in addition to the load and go product, the bank highlighted their mobile app and payment capabilities that are perfect for young consumers on the move. Finance brands can use first party data to deliver highly relevant content to their audiences. For example, brands could create a personalized financial literacy series on topics such as debt management, saving for college, or saving for retirement. So, online financial brand Simple Finance created this email specifically for younger consumers with content and product information selected for this audience. So, with the right technology, the brand could create corresponding campaigns across other audience segments instantly by automating content blocks that are dynamically populated based on audience attributes. And then finally, to trigger communications, finance brands can use first party data to create triggered email campaigns that are automated based on consumer behaviors. So I have an example here of PenFed that created this email, which is triggered by an incomplete credit card application on its website. So, in a recent report, it was shown that 50% of retail banking customers had abandoned their attempt to sign up for new financial services, indicating that there is a huge opportunity to increase the conversions by following up on an abandoned request. And then building stronger campaigns with lookalikes. Google ads, Microsoft Bing ads, Facebook and LinkedIn all have features that allow financial services marketing team to build a lookalike or similar audience based on their first party data. Because you have access to the first party consumer data, you can get Facebook's lookalike capabilities to create targeted campaigns based on their own consumer information. So that was first party data. Now, how do financial institutions capture second party data? Second party data is information retailers acquire through a partnership with another company that provides access to their first party data. Finance brands may collect second party data directly from the company that owns it, right? So in this case, there is no middleman again. So brands must find partners who are willing to exchange data for mutual benefit. Both brands should agree how data will be shared and ensure that they have the same approach to data privacy. The brands can explore technology solutions that can help to protect consumer data while allowing them to exchange data more efficiently. So, a few examples of what you can do with second party data. Mortgage formed a strategic partnership with State Farm that allows State Farm agents to offer Rocket Mortgage loans as a licensed loan originator. So the partnership enables Mortgage to benefit from the strength of State Farm's network of 19,000 local agents, which serve 84 million policies and accounts. Financial services brands that need to reach um, niche audiences can seek out data partners with customers in that particular niche, allowing the brand to build out their data set for an audience they might not have in their customer list. As an example, Bank of America partners with the National Association of Women Business Owners to boost exposure among a key target and communicate their core values as a business. Ally Bank partnered with media company XO Group to target consumers in key life stage moments. So XO Group created 21 content pieces on behalf of Ally Bank, which were delivered across the media network's publications, The Bump, The Nest, and The Knot, and covered financial advice for having a baby, buying a home, and getting married. So the campaign established Ally Bank as a financial partner for XO Group's readers and provided a key connection point for the bank to reach a millennial audience. So that was second party. How do financial institutions obtain third party data, which is collected by external data providers that do not have any direct relationship with the consumers whose data is being collected? So the data is collected from various platforms, apps, websites, then aggregated and packaged up in various data sets. 88% of marketers surveyed by Forbes um, use data obtained by third parties to enhance their understanding of their customers. So third party data is important for filling the gaps in your zero party, first party, and second party data. And it enables you to develop a much better complete view of your customers. So data providers can create packaged data solutions by industry, use case, consumer categories, and things like that. Now, what can you do with third party data? While first party data is valuable because of its precision and relevance, it often lacks scale, right? Because you only have what the consumer gave you. So, by leveraging third party data for additional insights into your own audience means achieving a more complete view of your consumer, which enables retail marketers to improve communications and generate new opportunities, such as what I have here is finance common interest. So, after supplementing their existing audience file with third party data, one particular financial services brand could learn their best customers are females aged 30 to 50 years old with children under the age of 10 in the household. And that 50% of these high value customers share a common interest, like having an affinity for a certain sport, and prefer to consume media via, let's say, social channels. So, this information opens new doors for high ROI advertising opportunities through uh, personalization. Financial brands can use third party data to augment their acquisition efforts. They can identify and target prospects at various life stages. For example, graduating high school, buying a new home, or expecting a baby, and deliver personalized content to engage and convert them. Financial, services brands could use third-party data to reach consumers who are preparing to move or find recent grads who might consider opening a new checking account. They can also tailor their communications to appeal to customers with a growing family who might have changing financial needs. So while the consumer is giving the data for better services, a financial service provider, apart from providing relevant content, should also focus on building a relationship with the consumer that has trust. And to speak more on that, I'll introduce our next speaker, Chris Hohman.
Hey, Manjeet, before we move on to Chris,
Yeah.
there was a question or a couple questions that came in. I want to just shoot your way before we move on. So the question was, in the case of that Bank of Tennessee, where they're boosting remarketing and acquisition efforts, do you have any idea what the level of customer engagement is with the quizzes? And their other question was, is there any way that those things get tied to net promoter score increases?
Yes, it does get tied to net promoter score increases. I think the first part of your question was about. I think I missed that part.
Well, it's about what is the level of engagement with the quizzes? Do you have any idea?
So the quizzes are pretty short. So this is to do with the zero party data, right? So the
Yeah.
quizzes are pretty small and have maybe less than about 4 questions. So the participation is pretty quick. And if you know your audience well, and if you deliver those quizzes, let's say on a mobile app, people are much more quicker in terms of responding. If you have a younger audience, and if you're, let's say, sending those quizzes by emails, then that's a big disconnect. So that's where you do not have the same level of engagement that you would want.
Are there any resources where you can learn more about, how successful these types of things are?
So I know the underlying technology. So, I mean, there's a lot of information about customer segmentation and how you can understand your audience. So there are resources out there. I mean, I'll be happy to recommend a few offline.
Okay, sounds good. Well, hopefully the person that asked this question can maybe email us and we'll send their contact information to you. Thanks.
Sounds good.
Okay, Chris?
Hey, thank you, Steve. Thank you, Manjeet. Great segue. You know, just to address that question specifically, you know, the types of engagement processes are, you know, they're generally targeted, very targeted per segmentation, per persona. And so there's generally, when they engage in these types of acquisition efforts, they're very, very focused at a specific outcome, and they measure a KPI against that outcome. So I've been a part of these types of engagement practices in the past, and they're usually very, like you said, so very trying to accomplish some kind of a goal. And so I think in terms of the outcome of that, it really depends on how good of quality you are putting into that survey or to that type of engagement activity. Just that my 2 cents to that question. If turning back to the presentation at hand, I mean, a lot of what Manjeet spoke of is spot on. I've spent the last part of 2 years working with large financial institutions, Bank of the West and Wells Fargo, in with a point of view around innovation and digital transformation. A lot of what has been happening within these institutions has been focused on better understanding of customers and who they are and how they are represented in the bank, both from an acquisition standpoint, but also in terms of overall strategic value. And I wanted to take a look here and put this in the terms of the notion of trust, because trust for a bank is critical. From the inside out, we look at trust in terms of risk in our relationship with each customer we bring into the bank, and how to manage that risk and how to maintain that relationship over time. Flipping that around, you know, the trust is, again, the institution of a bank is someone you're potentially going to share money with, share a lot of personal information with, be very intimate with as a relationship. And I think this is critical because what we're seeing now is some big changes as we go through the last 9 months of COVID, and how that's changing fundamentally the way the bank interacts with a consumer or a small business. And we can talk about some of that a little bit later. But so trust has been around with the notion of a bank, has been around for a long time, right? I mean, if you go back, given the season, Christmas time, you know, I hope to actually sit down and watch It's a Wonderful Life again. But it's, you know, that this notion of the banker really is a big part of your life, has been synonymous with banking for probably over 100 years. And this hasn't changed a whole lot. I mean, I think if you do a just kind of a general survey of folks around the globe, they still have kind of a notion of what a bank is, what a bank represents, kind of a stable entity in their lives. But I do believe that's changing, and some of the recent changes are accelerating that. And what does that mean from a data standpoint? Manjeet spent a lot of time talking about different types of data. And really, data is sort of the lifeblood of what we're trying to do within banking and building relationships, right? And so it's that data that's collected around an individual, around a business, that really helps enable some of those types of relationships. Next slide, Dan. And you can see that there's a direct correlation between trust and revenue growth. And this survey, this comes from an Accenture survey that was done, and we'll talk a little bit more. Accenture, I kind of highlighted some information that Accenture shared publicly, but it's the notion that trust with any type of company is very germane to the types of revenue opportunities. Banks in general have had traditionally a much higher degree of trust, which is good. It's a good starting point from a point of view of a bank. But we are also seeing some dynamic shifts in that trust model. Next slide. As we go into, you know, a period now that's very instrumental in change, right? So specifically within the context of COVID, what we've seen is a big decline in trust with the bank. And this was a study that was published. The Accenture surveyed 47,000 customers globally. It was just released in December. So this is right off the press. And you're seeing this huge decline in trust within the banks, and more so than other types of service providers, from insurance down to retailers, social network providers. And there's a reason for this, and kind of an obvious reason. One is that was pointed out in this study, but I'll go into a little bit more detail around this, is what they're calling or labeling the loss of humanity. And what that means is, there's, especially here in the United States and other major countries around the world, there's still a lot of branch activity, right? A lot of, especially if you look at demographics wise, older customers still associate banking with going to a branch to do their business. And these are strong relationships that a lot of these certain types of demographics have with the bank. Now that in the period of COVID, that relationship has changed, right? Banks are still services that are available, but the notion of going to a bank to do your daily banking needs has been diminished significantly. And there's a lot more digital activity around this type of engagement over the, and it's going to continue. I think this type of change that we see in the banking industry is going to be permanent. Of course, there'll still be a need for a branch, but much less so in the coming years. And the other aspect of this is around the value of money. I think because of that relationship, value of money becomes top of mind. And what is value of money? We'll go into that detail. I have a couple slides here that they'll go into detail about each one of these. But before I get there, I want to talk a little bit about the data around this trust. And this plays very well into a lot of what Manjeet had shared. But essentially, it's the data that is collected from the zero-party data all the way to the third-party data that's collected around a customer to understand, who they are as an individual and what kind of interaction you can have. But as you can see here, between 2018 and 2020, and largely this has happened in the last 9-10 months, there again has been kind of a lack of trust with data, about the data that you share with the bank, not to mention other types of institutions here, in particular payment companies, and how that data is being used. And there's legislation that's been enacted within California around consumer protection. There's been bad actors in the industry where large institutions have taken advantage of consumers and done things that were not in the best interest of the consumer. And frankly, a lot of the digitization that we've seen within financial services over the last 10 years has really been more focused on cross-sell and upsell, which really just means it's more trying to sell a product to an individual rather than building what I would call kind of a true personal experience with that person. And it's been more about marketing products than building a relationship. Next slide, Dan. And so, talking about this loss of humanity in a little more detail, so digital banking today is pretty much table stakes. If you're in payments, if you're in any type of financial product, from loans to deposit accounts, you can't survive today without some notion of digital banking, either on mobile, video, or some way to interact with your customers outside of a branch. It really is, it's a no-brainer. And in the branch, the second bullet here is the branch has been severely impacted during the last 9 months. And now that consumers are getting more accustomed to new ways of doing business with a bank and their money, that's going to be permanently changed. And the third bullet here about this out of sight, out of mind mentality, because they no longer have that same legacy type relationship with the bank, a lot of the need around management of their money and how to use money is going to transfer its importance or significance down to more at a transactional level, about more what you're trying to do, what you're trying to buy, what you're trying to get a loan for. That takes on much more importance in the mind of a consumer or the mind of a small business than that legacy relationship perhaps you had with the branch manager or an account manager within your favorite financial institution. And so it's, this being anonymous within this space now has made it less personal. And incidentally, it's also made it a lot more attractive to fraudsters. So now you have a lot more fraud being implemented within this space. Again, sort of highlighting that gap in data trust that we're also seeing from this most recent study. Next slide, please. And so what does that mean from a value of money perspective? So from, again, speaking from sort of the inside out, so services for the long term have to be top of mind for any type of institution or brand, financial brand in this space, right? So this means that you really need to take to heart lifetime value of a customer and not just focus on the next quarterly earnings or the next earnings season within that sector. It's something I've seen time and time again where you're giving up sort of this long-term relationship for short-term gains or short-term wins, and it's not right now, especially it's not the right way to sort of win the hearts and minds of customers. And it's much more than a sales pitch. And we're seeing a big shift, and sort of the last point here is we're seeing this big shift to different types of ways to interact with your money. And we'll go into a little bit more of this, but Apple Pay being an example here. And a lot of these large techs like Apple, Amazon, and Google are actually really going after, what you would call margin, or a lot of these fees that are associated with the larger institutions, from the few pennies of difference in rates to fees associated with certain types of transactions within your accounts. A lot of the neobanks are doing away with this. Neobanks, being equivalent to a digital bank, are sort of getting away from all these types of fees because they're just margin on top of what should be kind of a nominal financial transaction. And I put this quote in here from Jeff Bezos, someone who's he loves to take advantage of these types of opportunities where that margin business is a small segment, and someone like Jeff sees much more of mobilizing the larger ecosystem around the transaction. And that's really what he's done with Amazon, and probably what he's thinking about doing within financial services as they make inroads into loans and other types of financial transactions. Next slide. So at the end of the day, for financial services providers to survive in this day and age, I think it's worth having a revisit of the notion of trust. From an institution standpoint, there's two sides to that coin. There's, like you said, I've spent a better part of 2 years working on KYC and looking at financial models that protect and mitigate risk for the institution. But the flip side of that is you also have to think about how can we reestablish that humanity, that trust with the consumer. How can we build and personalize in a way that's meaningful for that consumer? And some of the methodology that Manjeet shared earlier, I think, was spot on to how to re-enable that humanity with your consumer. So trust, and this was a quote again, I think I got from Accenture, is trust is built on transparency, accessibility, customer experience, and control. Effectively, you give your customers transparency around their transactions, accessibility. So this would be omni-channel experiences from mobile to any type of digital experience you can think of, point of sale, just go beyond kind of the traditional ATM card. The customer experience, bar none, has to be top notch. Whether you're trying to get a hold of someone through a phone call, you're trying to Zoom someone or get on a video call with your financial institution, or you're trying to get a quick turnaround on some type of response. This is table stakes. and control. The more control you can provide your customers, the better. A lot of that financial information and education that Manjeet spoke of around providing surveys and financial education, I think that's fantastic. That's definitely a way to better engage with your customers. The conventional banking experience, I think, I'm not going to say the conventional banking is dead, but it's evolved, and it's going to continue to evolve from this point moving forward. And you're going to see a big divergence in how financial institutions either step up to that challenge and adopt a new digital mindset, or they fade away. Next slide, Dan. So what's next? I mean, there's a lot of big transformative things happening within financial services today. We've spoke a little bit around the sort of the tech giant innovation, and this is coming from all sides. Amazon, Apple, Google, they're heavily, I think what's well known today is the payment side of where they're participating, but probably lesser known is they're actually getting into financial products like loans. Amazon's doing a lot of small business loans. They're continuing to look at new ways to manage that type of monetary exchange with their customers. And I think this is going to continue to evolve. Largely, they're still partnering with banks on the back end, like Apple, for instance, is they partner with Goldman Sachs, right? So you still have an institution on the back end of that, but that might change too. I mean, I think right now there's a great symbiotic, there's a great relationship between Apple and say Goldman Sachs, but who needs who in this relationship, and how's that going to evolve? From the API, open API perspective, or open banking, as they call it, this has also been a very powerful shift. And we've seen this shift actually occurring maybe over the last 10, 15 years, but I think it's more important now than ever. And I think Manjeet mentioned a little bit around shared information, where you can share some of your personal information, and that provides a lot of value in return. And this speaks out to the heart of what this open banking phenomenon is all about. Like, think going back to Mint, Personal Capital, and a few other services today, where the more information that you share with them, they can provide a more complete picture of your financial snapshot of who you are and how your investments are working out for you, what kind of expenses are occurring, where you might be getting penalized and you're not even knowing it. There was a big Wells Fargo commercial, I think about this time last year, where they spent a lot of time talking about service fees from subscriptions that you might be assigned to. And that's important. I mean, I'm subscribed to things I have no idea I'm still subscribed to them, right? And unless you're spending a lot of time looking at your money or watching your money and where it's going, a lot of these things can slip through the cracks. So I think these types of services are very important and very valuable for the average consumer and on up the food chain through small business and other types of business transactions. Fintech disruptors, Klarna, basically one of the most valued fintechs coming out of Europe right now. They're making big impact here in how consumers actually interact with shopping here in the United States. But it's a unicorn, $10 billion unicorn. Robinhood, again, another unicorn here in the United States around investment, around sort of destabilizing investment the way it's done traditionally. They were single-handedly one of the major drivers for reducing fees associated with trading stock. And now the whole industry has sort of given up on any fees associated with trading stock. So that's pretty significant. And we've already mentioned neobanks, which are essentially digital banks. All digital banks, no branch associated with them. And most of these neobanks are from day one, they're starting with no fees on anything. So kind of it's re-leveling that playing field for the consumer. And I think these are major disruptors that any financial institution needs to keep track of. One thing that just happened today, actually, there was an IPO for Upstart, another financial services company that does loans, and they're using technology to reevaluate how they write loans and underwrite loans. And I think that's also very important. It's something that you're seeing more and more of today, and has some pretty significant impacts on how assets will be maintained, and how again, bank makes a lot of money by having assets so they can lend against them. In a lot of these new types of startups or sort of changing some of that, how we model that risk for a financial institution, I think we're going to continue to see that evolve. And the last one on this list here is blockchain. Bitcoin, of course, I think I just heard this morning that it was 23,000, now kind of a new high for Bitcoin. There's a lot of other coins out there. There's this notion of stable coin where you're associating a cryptocurrency with a stable market asset like a US dollar. So you're starting to see this become a bit more of a legitimate financial currency. PayPal and others are investing heavily in these types of activities, and it's only going to continue. And I think we're seeing adoption of these types of cryptocurrencies much greater outside the United States than we are here, even with some of the activity we're following with the likes of PayPal and others. There's also this notion of identity. How can I sign up and get qualified for a loan, and then take that qualification for that loan with me as a portable smart contract anywhere I go, regardless whether I'm working with one financial institution or one lender and go to another. That information around who I am and what it means to be able to qualify for a loan is mine. Why should it be owned by a financial institution? I should be able to walk anywhere with that. And so the notion of blockchain and being able to securitize and provide unique identity around these types of services, I think will also be a significant impact to how we conduct business in the very near future. And that's it for my presentation.
Hey, Chris, thanks so much. That was awesome. We have a question that I think both you and Manjeet might be able to address. It's really about the other banking sectors, the institutional banking sector, investment banking, and sort of bank-to-bank data exchanges. Any thoughts, comments on how data is being used innovatively in those settings?
Let me see. Wholesale banking, bank-to-bank data exchanges. I think it comes, and some of this might come down to how they create financial products and share loans between institutions, share, like bundling of certain types of products. I'm not super well versed on that side of the banking. I've spent most of my career in the financial services space on the consumer and small business side. But I do believe there's impact there, and a lot of it comes down to how these banks can make money and reduce risk. Right? It's about asset management and risk mitigation around the types of assets they're working with. But unfortunately, I don't have a ton of experience here. Manjeet, I don't know if you have any thoughts.
Yeah, I mean, just to add to what I think Chris said, if I think about bank-to-bank banking, it's still, one bank is trying to provide a service to the other. So as Chris kind of mentioned, it's about using that data. In this case, it would be the first party data that you have about your relationship bank that you have with, and use that data to come up with a better financial product for that particular bank. So in that kind of an association, the other bank becomes your consumer. So your consumer is not a individual, your consumer becomes an institution.
Thank you. Hey, Suneel, did you have some questions? I know you had some questions you wanted to pose.
Yeah, I've always got a couple of questions. Thanks, Steve. I guess the first question would be, just kind of this whole notion of traditional banking versus all these different startups that are entering the space. What's kind of the current status of government regulation? Has it caught up to them in terms of the new entrants, or is there kind of an unequal state of regulation between what traditional banks are subject to and what some of these other startups are operating in?
I mean, that's a good question, and I'll take a shot at that first. So financial regulation has evolved. Has it been? Is it completely caught up with the evolution around this space? Like, is there a lot of regulation around cryptocurrency, whatnot? I think that's it's still very immature. Any kind of regulatory practices around Bitcoin and blockchain, it's very immature at this point in state of the day and age. I would say the regulation around traditional products and product assets um, hasn't changed a lot. It has evolved, but it's still keeping up with the times. For instance, there's just a lot of compliance with respect to um, uh, assets at the bank, this notion of KYC and what that means from anti-money laundering and Banking Security Act. That's these are financial compliance um, policies that are currently provided by the U.S. government. There's also international bodies that provide additional compliance and regulations on top of protect the protection of consumers and small business in institutional money, right? So those measures are in place. Financial services providers do have to adhere to these types of policies. Largely, it comes down to when a institution does business with someone, there's a certain level of compliance they need to achieve to do business with that individual, and then that institution also has to make some individual decisions around how they can work with that individual. A good example of this would be Bank of the West, which is actually a subsidiary of an international bank, BNP Paribas. They actually have to adhere to a higher degree of regulation and compliance just because of their subsidiary relationship. And when a lot of these, like the payment companies, I mentioned Apple Pay, they work still with a legacy institution to underwrite a lot of these types of transactions. And so those legacy institutions that underwrite the transactions still have to meet all these compliance needs. And then it's up to the some of these fintechs to actually gather that information as part of their onboarding process to ensure that there's any kind of regulations are met in that process. So they still exist, but I think it's evolving. And in terms, like I said, in terms of Bitcoin and blockchain, I think it's very mature, and so you'll probably see more of that as that becomes more of a mainstay, financial vehicle here in the United States.
So if I could follow that up from a consumer perspective, since, as you said, Chris, a lot of this has become much more of an anonymous sort of relationship.
Yeah.
And a lot of what the institution does is provide, a smooth course of action in terms of dispute resolution, fraud detection, hacking. Do you think that the traditional banks still have any sort of advantages over the new entrants, or do you think that the tide has kind of turned and the banks are falling behind?
It's a great question. I think it probably depends on the institution whether they're ready to meet the challenges of sort of this new digital age or not. I think there's always, at least in the near term, the legacy bank, just because they have the assets under management, right? They have that power to still meet regulation around lending and loans and whatnot. They'll always be sort of at the back end of these processes. I mean, that's why you see a lot of fintechs partnering with larger banks right now, just because they have the assets under management, they have the experience with the regulators, and so that gives them the stability and also the core competency around this notion of working with money in and around money. But I do think that might evolve. I think as compliance and regulation do mature and get caught up with some of the changes happening on the digital side, I think we could see a fundamental shift in how that compliance is managed, and it might fundamentally change how some of these fintechs do business with customers. So I don't see an immediate shift, but I think that could be down the road a very likely outcome.
Thanks, Chris. That was helpful.
Yeah, I see another question came up. I'm not informed on this Basel II Accords.
Yeah, neither am I. So I think this is the international standard for financial institutions compliance. I think so that I think falls outside our expertise.
Unfortunately, we didn't bring our Basel II expert today, but next time we'll get that person in here. But anyways, hey, I think that we've come to the end of our webinar, and really want to thank the presenters again for terrific presentations, very well thought out, very well presented, and very interesting. So we really appreciate Chris and Manjeet. Thank you so much. And
Thank you.
thank you, Suneel, for being the brainchild behind all this. I think it's been an excellent program. We've had about 6, I guess, so far, and they've all been terrific. So we will turn it back over to Michelle to wrap it up. I want to thank the audience again for attending today, and hopefully you got something out of it that you'll be able to use in your business or law practice going forward. Michelle?
Thanks, Steve. And thank you everyone for joining us. And thank you to our speakers. And everyone, please keep an eye out for new webinars coming out in the new year. And most of all, we wish everyone a warm and safe holiday season. Thanks again, everyone, for joining us, and be well.
Thank you all.
Thanks, everybody.